In the heart of Miri, Sarawak, conversations about homeownership and bank loans are often laced with one persistent question: what is DSR, and why do banks scrutinize it so closely? Imagine Faridah, a young schoolteacher living in Miri. She dreams of owning a modest terrace house not far from her workplace. With her savings prepared, she enters the bank, hopeful and slightly nervous, to apply for a housing loan. The bank manager welcomes her warmly, but soon asks, "May I know your current DSR?" DSR stands for Debt Service Ratio, a financial metric lenders use to evaluate how much of an applicant's monthly income is used to repay debts. In Faridah's case, her DSR tells the bank how comfortable she will be managing both her existing and new loan payments in relation to her salary. In Sarawak and across Malaysia, banks generally prefer DSR values below 60%. Some may set even stricter limits for better risk control. Faridah's monthly salary is RM4,000. She already pays RM500 toward a car loan and has a monthly credit card payment of RM200. If she is applying for a new housing loan with a projected monthly repayment of RM900, her total debt obligations sum up to RM1,600 each month. Her DSR is calculated as total debt payments divided by monthly income, RM1,600/RM4,000, or 40%. This looks favorable. From the bank's perspective, the DSR is decisive. A low DSR suggests Faridah is not overburdened by debt and therefore unlikely to default. However, if her existing debts were high, say, half her salary, the bank would worry she might struggle if any unexpected expenses arise, or if interest rates increase. But why are banks in Miri, Sarawak so strict?
Part of it is local context.
Miri's economy is diverse, but sensitive to oil and gas industry fluctuations. Banks want to minimize risk, particularly where customers' incomes could change abruptly. By monitoring DSR, banks seek to ensure not only their own stability, but also responsible lending practices in the community. DSR also impacts more than just loans. It determines how much financing customers may obtain for cars, renovations, even business startups. If Faridah's DSR were already too high, she might have to reduce her existing debts or increase her income before trying again. Some banks might offer flexible packages to help. In short, the debt service ratio functions as both a safety net for borrowers like Faridah and a compass for banks navigating customer risks. Understanding this ratio gives people in Miri, Sarawak, and anywhere a realistic picture of their borrowing power, helping them chart a steadier path toward their goals.